Hello and welcome to the MedTech Wealth Advisor Podcast with your host, Matt Nelson. Matt, good to be with you. I understand today's episode, you're going to delve into a little bit of the investment philosophy that you follow.
Yes, we are. I'm looking forward to it. I mean, last episode we got to meet Matt, hear a little bit about his background, Matt Finley, my partner. And I thought this would be a perfect time to just bring him back and he and I could just chat about what we have put together in our collective belief system
Mm-hmm.
for how we run portfolios and manage money for our clients. It should be a good discussion. There's a lot to it, and to try to reduce it down to a half-hour episode is could potentially be a challenge, but I think we'll give it a shot. I think we'll be okay here. So, just as a way of introduction, further introduction, when we formed our partnership a few years back, Matt, we were mostly aligned on our investment philosophy, our financial planning philosophy. Um, I don't think either of us had formally spelled that out for ourselves. And so, it was just a great exercise when we came together to just get really clear on the why, like on why do we do things that we do for investment portfolios, the strategies we have, what is it that we're really doing for our clients. And, not only as we make day-to-day decisions, but just so we can clearly explain it to clients. Do you kind of remember back to that time and as we were
Oh yeah.
just spitballing? Yeah.
I mean, obviously we ran our own client portfolios prior to our partnership, and like you said, we were pretty closely aligned. But getting those aligned on a practical basis, taking care of our clients and our portfolios, and then actually having a philosophy that we agreed on and write down, it takes some time.
It does. It does. And it's a lot different when you think about making investments for yourself. Let's just say as a do-it-yourself investor. Whole lot of different decisions you can make and ways you can approach things than when you're doing that on an institutional level for hundreds of clients, hundreds of millions of dollars. You need to make decisions that are defensible, that you aren't trying to make knee-jerk reactions on any given day. And so I think what we've come together to believe in how we run portfolios is working really well. And I have a lot of conviction around it. So let's just jump in and I'm going to preview so that we kind of boiled it down to a nice tidy 6 numbers here so that we could kind of match up with the group name. How's that for marketing cachet there, Bill?
I'm impressed. I'm impressed.
That's good.
Perspective 6 has 6 points to talk about.
There, exactly. So the 6 are that number one, we are investors versus speculators. We believe in staying invested versus market timing. There's a belief that the loss of buying power is the real risk versus just fluctuating principal. We favor being owners versus lenders. And we think long-term economic data is much more important than a lot of the industry opinions you see out there. And finally, portfolios for income, they're not the same as portfolios for accumulation. So a lot to unpack there. We're going to jump in. Anything you want to say before we kick off, Matt?
Nope, I think that's a good preamble.
Okay.
And I think we can just describe these as we go.
Yeah. So, what do we mean by when we say we're investors versus speculators? The thing is, this comes with a central belief that the power of growing global economies is going to result in a compounding of investment returns over time. That just in general, we can see that the economic forces at play all over the world, particularly in the U.S., are going to and continue to create wealth. And so we want to be part of that through the investment markets. As advisors, really what we're trying to do is help clients create a core portfolio, not just to store up the wealth that they're accumulating, but to be able to use that for later use. So if you think about what's really happening in a financial planning situation, someone goes to work, they trade their time for money, and some of that money they need to use today, some of it they have to store up. Pretty simplistic way to think about it, but that stored wealth, they have to use that at some point, and costs are going to be much higher when they need to use it. So the biggest piece of this is that we need to be investors for the long term, for for decades versus days, and not just speculating and jumping in and out of markets. That really creates us. We have to kind of have a focus on high quality, consistency, sort of predictability. Matt, anything you want to kind of add to how you think of that?
Yeah, that's exactly the last statement you said. Some form of predictability, because when we're doing financial planning, we are, the further out you get, the more unsure the data is, of course, because today's effect changes 20 years from now bigger. But to be able to project out and make some assumptions for somebody's retirement cash flow needs, as an example, to achieve that, we have to have some predictable growth rates. And there's obviously, that's another conversation on how we go about that, the predictable growth rates versus actual returns. But that speaks to our core belief of being invested, and growing economies create a growing stock market.
Yeah. Yeah. I think maybe if you think of it this way, it's not about making the most money possible for clients. That might be something you would look toward if you were speculating. How do I get rich quick? Really, what we're trying to do here is we're trying to protect clients from losing time, from losing out the long-term growth that the public markets have available to offer. So it really is a protection. It's not, when I say protection, I don't mean from like losing money to the downside. I mean, just literally losing out on essentially the returns that are there for the taking. They just have to be invested.
Correct.
And unfortunately, what investors experience versus what the investment markets provide are often very different things. So it's to your point, Matt, having predictable averages is going to get us a lot further than sort of these unreliable, but maybe like sky high returns everybody's hoping for.
Right. And we'll get into staying invested versus market timing, but it kind of plays into that. And between financial industry and your coworker next to you, it's all about fear of missing out. And
Absolutely.
And that speculation, therefore, that comes into that. Just like we were talking about going to you go to a casino and people never tell you their losses, they tell you their gains. Well, that's what your cube mate's telling you, right?
Right.
But we'll talk about that here in a minute for sure.
It's not a game, is it? It's not a game.
It's not a game.
And so, along with this, as we think about being investors versus speculators, so this is part of this philosophy leads us to the types of investments we use. So we tend to stick with highly liquid, publicly available investments, publicly traded markets. And that can sound kind of boring, like, well, where's your sort of like exotic, fun stuff? Well, there really isn't a place for just a bunch of fun stuff in core portfolios. We need to cover them with predictability and liquidity. There is a place for some investors after really that core portfolio has been established and we have our goals kind of in place, to add additional pieces to the outside. For instance, in private equity, so non-publicly traded companies, startups, real estate, physical assets, all of those have a place potentially in a portfolio, but not for everybody.
And actual real estate, illiquid
Yes.
real estate, so they can take advantage of the real benefits, tax, income, versus just buying the real estate ETF.
Yeah, that's right. That's right. Exactly. So there's reasons to add those additionals. Doing them in the right way is is super important. And just a little bit more on this before we jump on to kind of number two in our core belief. When we were prepping for this show, Matt, we talked about, well, when does it make sense to add pieces to the portfolio? And I'm not saying that we necessarily do all of these things for clients, but when should an investor have these additional pieces of their portfolio, and how would they think about doing it? So we just kind of went through our process on that. We started with liquidity is the most important. That's why we use publicly traded investments. You're going to get average returns with publicly traded. When I talk about publicly traded, I'm talking about the stock market, in quotes, the S&P 500, the Dow Jones, sort of these well-known indexes. Now there's a place, I'll start with this one. There's a place for private equity. People can make a ton of money investing in startup companies.
Right.
And it's a shiny object to chase. It's like, well, I just want to find the next Google. Well, okay, first of all, good luck. There's a lot of choices there. But when you think about private equity or startups, realize that what you're doing there is you're investing in a business. It's not the same as buying a stock. Okay. And what I mean by that is, you're much closer to the ground level of what's happening. We talked about our company the same way. Running our practice, the business that we have, is probably the largest piece of my wealth. If you looked at my personal wealth, mm-hmm. If that much was in a single stock, it would be terrible.
We'd scream.
Yeah, that's right. Any advisor would say that's a terrible idea to have that much of your portfolio in a single bit. But the difference is we're running a business. We're personally invested. We understand what's happening. We can control the levers. It makes sense to be overly concentrated into that sort of private company investment. When you're buying startups or private equity that you're not running, you have no control, and a lot of it's just it's like shooting throwing darts at this point. And so in order to make that work and get the kind of returns you hear about in private equity, you have to buy a lot. Diversification is the key. So number one, do not go out. If you're listening to this, do not go out and just next startup your friend tells you about that sounds like a great idea, just throw a chunk of your portfolio at that. You have to go about it very, very methodically and plan to have probably 20 or 30 different holdings to make it work. I heard a statistic that, for about every 10 private equity investments, six or seven of them are going to go bankrupt. Maybe 2 or 3 break even, and maybe you hit it big on one, and that's got to make up the losses for all the others. And so while the returns can be there in private equity markets, you have to be able to invest a large enough dollars to capture a large enough number of these investments to actually get a couple that do well. So,
and it's 100% at risk money.
And it's 100% at risk money. So case in point, what for most people, it just doesn't make sense. Their core portfolio needs to be in public markets. They're liquid. They don't have the size of the portfolio to devote a piece to doing these private equity pieces. So you have more experience in the real estate side, Matt. Talk about how maybe there's some parallels there with real estate.
Yeah. So obviously real estate's pretty simple. It's extremely illiquid. You have to have a buyer for your sell. And you have no control over the market. It can take days to months to years to sell the real estate. If you own a 100-unit apartment complex, that might take a long time to sell. The idea with real estate to invest in privately like this is to take advantage of the tax savings you can get, and of course, hopefully, the income you can drive off of it. Which in the real estate world, you typically want to use to reinvest into additional real estate, sure. Right? So it really is a way to make some great long-term tax efficient money if you have similar full at-risk money available to you. So
Yep.
again, for our typical client, even though we work with some pretty high net worth clients, it still has to be money above and beyond their projectable needs. And they have to be willing to take a complete 100% loss on it if they're going to even consider private equity. And it might, I think in real estate too, it has to be that same type of mindset, because it
Right.
might be a 20-year hold before you can liquidate. And I don't know what real estate's going to be in 20 years.
Right. Exactly. And the last big one I think would be maybe like other physical assets. We get questions occasionally about gold, or should we own commodities? Like what about art? All these things you hear where, oh, you can get great returns in this. Why do we have all these stocks? Well, because you sort of have to be honest with yourself when you think about those, that you're now making a speculation. You're making a speculative bet on the price movement that gold for some reason is going to improve dramatically faster than the rest of the entire economy, the stock market. It doesn't pay anything, doesn't pay any interest, costs you money to hold it. Same with commodities and art. So the reality is that there could be a place in the portfolio for pieces like that. We're not saying that you should never have them, but realize what they are. So as part of this kind of tenet we're focused on here is, our first piece of our credo really is that we're investors versus speculators. And being investors means we're going to hold a pool of publicly traded investments for a long period. There's a place maybe for private equity, for real estate, if you have your core portfolio covered, but only if you can do it directly and have enough money allocated to it. And the other piece is the alternatives, like these physical assets. Just realize what they are. You're not really investing in them. They're speculations.
Yeah, because the acquisition and selling component of physical gold, physical art, things like that, is very taxing. Might be the
absolutely.
right word, right?
That's right.
It's very costly to do that. And conversations we have with people all the time are, okay, what is the reason you want to hold a gold, significant amount of gold coins or something like that? Okay, you're afraid about XYZ, right? And so, but now again, I'm not anti gold as an example. I do think it can have a place, but it has to be a logical investing reason, because again, we're not speculators, we're investors, because we're looking at 30, 40, sometimes 50 years with our clients that money has to survive.
That's right. Yep, exactly. So that the second tenet of our philosophy here is really that we believe in staying invested versus market timing. So we kind of touched on this just a little bit already, but generally, so when we realize that we're investing for decades, not days, that speaks to that speculation side too, but we're going to stay invested. Okay. Market timing creates a lot more risk than reward, typically, at least the way we view it. And when I define market timing, what I should just put some connotation to that. We're referring to sort of going all in or all out with your portfolio, or even in really significant ways. Hitting points in the news cycle, which is usually what drives this kind of stuff, where it's just, oh, well, the sky is for sure going to fall next week. I for sure need to sell half my portfolio so I don't lose out and become a bag lady living under a bridge for the rest of my life. That's kind of the fear that goes around that. But we tend to believe, again, tenet number one, if we're investors, we're buying swaths of the entire global economy, we can stay invested for long term. Now, Matt, you have brought to the table some ways to think about how there may be some room to adjust around the edges for some viewpoints that still marries that with our thinking that we're never going to be all in or all out of a portfolio. So speak to that a little.
Yeah. So obviously, the core of our portfolios, we want to stay invested, period. around the edges, so to speak, gives us some opportunity based on long-term economic data, maybe historical technical data, to make some adjustments and take advantage of some opportunities. An easy one to relate to for a client, maybe if the stock market is down 30%, that should be much closer to a buying opportunity than a selling opportunity. And while we stay fully invested with the core of the portfolio, we may have some opportunity on the edges to adjust what we're invested in. So it's not a market timing. It's more of a logical or an economic approach. I believe it was Warren Buffett who said he didn't want to buy a position unless he was willing to hold it for his entire life. But he does take profits, and he does take different positions, and he'll sell. Let's say he sells half of a position he has. Well, there's a logical reason he's doing that. It's not trying to time the market that stock specifically is done on its run type of scenario. So there's economic basis. If there's significant gains in a position, or another easy example is rebalance scenario. If a position we hold has far exceeded the rest of the portfolio in return, that may be one of those opportunities to trim back to our model positioning and take those profits.
Right.
And then reallocate that somewhere else.
Exactly. Yeah. What we saw recently, that's still pretty recent, with the COVID crisis that made the markets of 2020 pretty ugly. That'd be an example of a reaction, an investment market reaction that probably created opportunities to add a little risk to portfolios. So,
right.
Is that market timing? Well, not in our view, or in our view, that's saying things are drastically on sale. This probably makes some sense to add a little bit more of what's on sale. And as things, return or come back to some form of normalcy, maybe just kind of return to our more target allocations. So, we could go on and on about this kind of point. We need to get on to the other few we have, but in general, so staying invested versus trying to jump in and out. But I think that leaves room to adjust around the edges with some prudence.
Yep. Some data, some prudence, some opportunity. It does allow us to minimize the noise.
Yes.
I think is how we often describe it. Noise being what's on your financial media, what's on your social media, what your neighbor, coworker are talking about, and put some real history to it, whether it's the outbreak of a war or Congress not acting right. Oftentimes noise that we can see through because we do have that longer term economic approach.
That's right. So number 3 is that we believe that the loss of buying power is the real risk versus just a fluctuation in principle. Temporary price fluctuations in a long-term investment are immaterial. It's kind of the idea that if you had pricing information on your house every day, you'd be a lot less comfortable holding that house. Okay. Think about it. You're living there, you're using it. To you, and real estate only goes up because about the only time you care about it is every few years when you happen to take a look at it and decide, well, if we sold the house, what would it be worth? And it's worth more. But that's, guess what? Because you didn't look at it for several years. So the real risk here is not that your portfolio is moving up and down. It's that you can't actually keep up with buying power.
Right. Inflation, the compounding effect of the markets that we love, has the same negative effect in the compounding effects of inflation.
That's right. Inflation, I mean, it's sneaky. It's kind of it's deadly really to an economic well-being. And so because of that, we typically are encouraging clients to take more risk really with holding stocks in their portfolio, often holding more in their portfolio than sort of like the industry, gurus will tell you for your age. We'll get onto some sort of fallacies that we try to stay away from here in a little bit. But the realistically, if the biggest loss of the biggest risk is a loss of purchasing power and not temporary fluctuations, just ignore what the portfolio is worth in the meantime. Number 4, I should say. These all kind of link together. So number 4 is we believe in being owners versus lenders. So just to the point above, if really the risk is loss of purchasing power, well, how do we kind of keep up with inflation? We think the way to do that is to own more stocks, to be owners of companies, not lenders, not owning lots of bonds. It sounds maybe to a seasoned investor that may sound basic, like of course, stocks earn more than bonds. But I don't think it's taken to heart the same way as like, there's almost no reason to have bonds for return in your portfolio. Bonds play a whole different role. They're there to maybe create a little ballast. They might be there to set aside money if you need to spend it. And we'll talk about that in the retirement section. You got to think about it. We're looking at ownership in some of the best run companies in the world. If you had your chance to, in retrospect, invest as an owner in Google versus just lend them some money to build their facility, like what would you do? And so think of it that way. Any comments on that, Matt?
Yeah, it actually ties into the real risk we believe is inflation. If inflation, let's say over the last decade, I think the number is around 2.7% annualized. Bonds over that same time, US bonds over that same time, only about 1.6% return annualized. Stocks, on the other hand, about 12.5%. So now we can look out further, right? We could look out 30 years and maybe bonds, because they were paying higher in the 90s and early 2000s, would keep up with inflation through that time. But you're still missing out on the power of the equity returns. And over 30-year period, the S&Ps outperformed the US aggregate bond market, by 1,500%. So that just kind of speaks to our core belief of being owners versus lenders.
Yep, absolutely. I mean, there's no guarantees either way, right? I mean, you're not guaranteed to get your money back from a bond or a stock. You may as well be an owner and kind of have the upside. As long as you're not speculating, you're not just jumping into a stock to try to flip it the next day. If you're investing, take ownership in the company.
Right.
So number 5, just moving on to number 5. So we believe in long-term economic data over industry opinions. This is a particularly a thorn in your side, Matt. I want you to kick this off.
Yeah. So it's, economic data it's all tied together. So the performance of our stock market and the companies that make up the stock market is a significant portion of our US economic data. And you could look globally as well. But if you look at the long-term economic data, it can be a roadmap for what's happening or where we're going, whether it's a good positive trend, maybe slowing down trend, and so forth. Unfortunately, in the financial realm, we get a lot of selling of product or selling a company specialty, and you even hear that on, financial media. You got to be really careful about who's saying what and why. And if you just look into the why, then oftentimes you understand what's going on. So a lot of fear mongers on, the financial media. Well, they might be a bond shop. And so they want people to move from equities to bonds. And so they're going to get on to the show every week and talk about that. Or they might own a gold shop, or they might be a mid-cap equity shop. That's what they specialize in. And so they come knock on our door as a firm and, try to drum up that business. So simply in our careers, we've learned to try to, again, much like we recommend clients to ignore that noise and understand the long-term benefit. That's what we try to do as well, is what is the intent behind it? Let's look at the historical information. And so I think that's where we've really, dialed in on our core beliefs that economic data speaks the truth.
Yeah, absolutely. Yeah. And don't follow the industry rules, so,
Right.
so not only, just speaking of what you were saying, it just, what's really the incentive behind the so-called wisdom or advice you're being delivered. But then there's a lot of just industry rules that become this rule of thumb, and do this, don't do that, do this, don't do that. And I wanted to point out a couple of them that we kind of we sort of reject this commonly understood. So for instance, just using an asset allocation portfolio, just a portfolio that has a little bit of everything, and always hold it. Well, that makes sense. Don't put all your eggs in one basket. That sort of idea gets extrapolated to mean you should always own part of everything. Well,
Right.
as we saw, for a great example, as we saw in 2022, if you just simply held a bunch of bonds and a bunch of stocks because you're just supposed to do that, well, bonds really got hurt in 2022.
Worst ever.
And the economic data said that was going to happen. That was the mathematical fact. Now, is that a market timing issue to not hold something? No, it's just looking at, we're investors versus speculators. We want to own, but there might be times we want to adjust, and just holding a bunch of different assets just with the blind belief that holding a little bit of everything protects you it's just uninformed.
Yeah. And I think it actually speaks, Matt, to our fiduciary responsibility to our clients. If we know economically that something is happening, such as inflation, and we know the effects of that on different asset categories, and it's perceived as negative, and we have the opportunity to maybe help that a little bit, that's that opportunistic approach that we have to take around the edges to, in that case, try to minimize that inflation effect.
Yeah. Knowing that we every time we make a choice, we could get that wrong, and we have to accept that. Every
Correct.
time we make a call that the stock market is going to continue, it might not, that bonds will go up, it might not. And so that's why we're very careful when we say adjust around the edges. But just a couple others that, just kind of things that are rules of thumb that we don't necessarily follow all the time. Just owning a bunch of bonds because you got older. Your age has nothing to do with your asset allocation. It really shouldn't.
Right.
It has, maybe there's a side effect that generally as you're older, it may mean that you need to spend some of your portfolio. That might mean what you're spending is set aside in a little bit less volatile or fluctuating parts of your portfolio, but it has nothing to do with your age. Just that means you should own cash or bonds or anything like that.
Yep.
Dividends is this one bugs me, that somehow if you want a safer portfolio, just buy a bunch of dividend stocks, that they're more consistent, that it's somehow better. They're just all different reasons why you would own dividend stocks. And what I like to think about is look, if Apple sells a bunch of iPhones and makes a bunch of money doing that, and then that year they just gave all the profits back in dividends, they don't have a whole lot left to do further research, do R&D, to invest in the company, and potentially grow the stock price. So I'm not saying dividends are bad, but when companies just constantly return all their profits to you, it has to naturally offset some of the growth potential. And you have to take that into account. It's not one is better than the other. It's just kind of leaving this belief behind that you always do this, you don't do that.
Yeah, because at the end of the day, for us, we view it as total return is the right answer.
Right.
Right. And so therefore we want to analyze a segment, a sector, a stock for its total return potential, not just it's maybe it's in a mutual fund world, like a fee conversation, right? I still
Right.
want the total return benefit, even if it costs a little more. Or in this situation, maybe the dividend stock is a great holding to have it, or as we'll get to in number 6, why we would possibly want some
Why?
dividends,
That's
right, is the
right.
bigger question.
That's exactly right. So yes, so as we're getting long here, let's jump on to number 6, which is that really investing for retirement income, it needs to be different or approached a little differently than just investing for accumulation. Um, Now, what I mean by that is you don't necessarily have to hold different investments. It could be that right before you retire or reach a point where you need to spend from your portfolio, and right after, your holdings, the core of those holdings could be similar, but just simply um, having a big asset allocation portfolio, like we talked about in the sort of the rules of thumb that the industry espouses,
Right.
and just selling a little bit at regular increments and then spending it, that may not be the best approach. We think of retirement portfolios or portfolios that need to be spent from as needing to be divided up into um, sections, maybe buckets. You could think about them as buckets. So talk to that a little, Matt, as to how we do that and maybe why.
Yeah, so we'll just speak like an average client, because everybody's needs are slightly different, but an average client, if they're taking income, and they've, done a good job at saving their assets, we want to have a different strategy for that is geared towards protecting that income need. And we specifically target roughly 5 years of income that we want to protect in that nature, of money that they'd have to withdraw from their accounts. And we're not necessarily after growth out of that money, although we'll get growth. But that it's protecting that. And we refill that in a very strategic way that we don't have time to go through today. But what it tends to do is the remaining portion of their portfolio, we're allowed to push more for the growth, because a
Right.
typical retiree still has 20, 25, sometimes 30 years their money needs to last. And that gets back to why a 50-50 portfolio might not work for them, right, to
That's
cover
right.
30 years. And so, again, getting away from the industry rules of thumb, so to speak, we believe in a portfolio mix should be more geared around what income they need in retirement, and that dictates their allocation, if you want to look at it that way, versus their risk tolerance, versus their age, as an example. And I don't know if
Very,
that explains where
that,
you want to go with that, but
yeah,
that
no, that's,
allows us to protect actually their income needs and still grow their assets.
yeah, that it's exactly right. It's the idea, as you alluded to, that we look at it from an income need standpoint versus just a perceived risk tolerance standpoint. Okay. And the
Right.
reason I think perceived is a key word in there is, years back, this is how I did things for retirees. Okay. Kind of industry standard of, well, how aggressive do you feel? Oh, well, I don't want to take any risk. Okay. I don't want that. The client, of course, would say that I don't want to take any risk. That who wants to take risk? Okay. So you're a conservative investor. Yeah, I'm very conservative. Now I want about, 30 or 40% return, but I don't want to have any risk. That's kind of like two opposing views, right? This idea of a perceived risk tolerance, it's very difficult for clients to really know themselves. I think far too often leads to portfolios that are uh, more conservative than they should be. They're far too conservative. So if we
Agree.
flip that and we say, what's really the need here? Okay, do you have this portfolio that's worth, $1 million or $2 million, whatever the number is. You need to spend just this portion of it per year to supplement your other sources, your pension, your social security, and so forth. Well, maybe that amounts to just 1 or 2% of the portfolio value. Well, if we carve off enough to protect income for, say, the next 5 years, now we can turn around and say, look, no matter what happens, at least the next 5 years, we have a very conservative portion of your portfolio to spend from. You don't have to worry about it at all. The rest can be invested for growth. There you go. We've now just backed into how aggressively they really are able to invest, not just based on what they kind of are guessing, finger in the wind. So
Right. And a side benefit to our strategy is that when markets are down, we don't have to sell on the equity side to send money to them.
that's right.
And that is the traditional industry model actually requires selling in all markets. And we've seen that damage clients' future prospects significantly.
That's right. That's right. That's why we're shifting. Well, this is good. I know we could go on for quite a while about all this. And so, just kind of to summarize, it's look, if you want to have an successful investing experience, you need to identify just your core investment philosophies. We've laid out ours. You're going to do this on your own. Take the time to kind of write them down and decide, this is how I'm going to go about building a portfolio. Even using what we've laid out today, which sometimes seems very broad, it does drive day-to-day decisions of what you buy, when to sell it, when to hold it, and so forth. Let that form your portfolio decisions. So, just kind of wrapping it up. Did we strike a chord for you, Bill? You have any words of wisdom?
Yeah, I had a couple of. Actually had a couple of observations and maybe a question or two. One is it has always been interesting to me when people talk about dividend income, because what they need to remember that it is tied to the price of the stock, which changes the overall income of the stock. Number one, right? It also mitigates the loss associated with the stock if you're holding it. So if you're getting a 4% return on a stock, and that stock goes down and its stock price loses value, you have technically lost value in your portfolio, but it's offset by by whatever income you've got coming in on that. So I think people sometimes think, oh, income from dividends is somehow sacrosanct and always there and to be relied upon. They need to understand that it's tied to an equity.
It changes.
Fundamentally
Exactly.
tied to an equity, right?
That's right. That's right. Yeah, could look very different 6 months after you purchased it. And so, yeah. And it's that, what I talked about earlier too, there's no free lunch. So if you're getting a bunch of the profit back in the form of a dividend, naturally the price of the stock is going to have to grow a little slower. So it's okay. Just know what you're getting and why you hold it.
Yeah, exactly. And the other thing that's interesting, is that I still hear people talk who think technology is something to shy away from. And
Like
my
it's aggressive or
argument back,
something,
and I want to hear both of you respond to this. My argument back is always technology today is what Procter and Gamble and what
Yeah.
General Mills was once upon a time, because our lives are intertwined with massive amounts of technology. And so I'd love to see if you think we need to, you would talk to your clients and say, hey, technology has an appropriate real place. It's not the shaky, weird, speculative buy anymore. It's part of your life everywhere you look.
Yeah, right. Back to the idea of the NASDAQ, and prior to 2000, it's like investing in the NASDAQ is basically investing in technology, and that's super aggressive. That was the idea, right? The understood. Yeah. To your point, I mean, now here we are. Is Apple really an aggressive tech company, or is it actually a cornerstone to the entire global economy? Like, I would probably lean toward the latter. Like, it affects a lot of parts of the world. So I think your idea is spot on, Bill. We should focus a little less on some idea of what aggressiveness means by the industry, and just focus on be like Matt Finley, the scientist and the data researcher, right? It's about where's the economy going? What makes sense? What are the economics telling us?
Yeah, it
What's
kind
the
of fits
big
in, it kind of
long-term
fits into your
trends?
idea. It kind of fits into your whole idea that you mentioned about don't follow the rules, because the rules change, right?
They do. That's good.
Correct.
Yeah.
The rules and the noise are the two things to not follow,
Well,
right?
the noise is the hardest. Okay. There's
Yep.
everybody,
Yes,
everybody's got FOMO, everybody's got noise, everybody's got the next big thing, and everybody somehow mysteriously, kind of like Instagram, where everybody looks beautiful and
hmm
just amazing all of the time, and they have crazy, crazy lives that you want to have. Somebody always has that portfolio that you're supposed to have or want to have.
boring and consistent when it comes to investing is far more attractive to me than sort of the quick, sexy, get rich,
Yeah, well, it's also,
tomorrow
I got to
schemes.
tell you, I think it's wise to remember, like, social media is an illusion.
That's
Much of it
right.
is an illusion, you know, as Matt, or the other Matt, as I call him, as the other Matt said, nobody tells you about their losses. Everybody's got a perfect life and a perfect portfolio.
That's right.
And all of us know that's just not how it
That's
works.
right. Exactly. Very good.
That's great, guys. Thanks so much. It's been an interesting conversation, and I'm sure people liked hearing how you approach the markets and how you look at them. If they want to talk to you further about this, how do they get a hold of you? How would they reach out to you?
You can call us at 952-225-0333. You can also just check out our website. We've got a very nice blog that's building content out there. Address to that's perspective6group.com. It's the number 6. And we'll probably be posting sort of this investment philosophy kind of credo, if you will, out to our blog at some point. So certainly go take a look at that. There'll be a link to that in the show notes. We have that ready, and yeah,
That's terrific. Well, guys, thanks for another interesting conversation. Good visiting with y'all in this podcast. Thanks so much. Listeners, thank you for taking the time to listen today. We hope you found it valuable. And we also hope that you're already a subscriber. But if you're not a subscriber, this is easy. Hit the subscribe button. It's right there. That way, you will always be notified when a new edition of this podcast comes out, and you won't miss another one. If you like it, tell people about it. Share it. Get the word out about the podcast. Maybe they'll find it useful and interesting as well. On behalf of Matt Nelson and everybody at Perspective 6, I'm Bill Tucker. Thank you for taking the time to listen today, and reminding you that you can go out today and make it a great day or not. It's your choice. Thanks for listening. Have a good day.